Hello everyone, welcome back to my YouTube channel Legal World. Myself Dr. Seema Goyal. As in the series of banking law, I have discussed many important questions relating to the banking law. Today in this video, I am going to discuss one more important question that has been asked for many times in the previous year question papers. My question is, what do you mean by secured loan and what are the modes of securing the loans by banks? Secured loans are approved or supported by the assets belonging to the borrower in order to reduce the risk assumed by the banks, with condition that the assets may be forfeited by the banks in case of the borrower fails to repay the loan or fails to make the necessary payments. As per Section 5 Clause A of the Banking Regulation Act 1949, a secured loan or advances means a loan or advance made on the security of assets, the market value of which is not at any time less than the amount of such loan or advance. In simple words, the secured loans are the loans on which some guarantee of returning the money is given, and such guarantee may be given on tangible assets. Secured loans are also known as homeowner loans. Generally, the banks accept a large amount of loans. So the banks don't grant large amount of loans without security. So the bank do not grant large amount of loan with any assurance that the money will be repaid. Rather than security is taken. Thus the features of secured loans are as follows. First feature is secure loans must be made on the security of tangible assets such as goods, lands, building, gold, silver, government securities, etc. Second one is market value of such security must not be less than the amount of the loan at any time till the loan is repaid. Third one is there is lower interest rate, higher borrowing limit, and the longer repayment terms in the secured loans. Next one is such security which is in the form of goods, building, land, gold, silver, etc. that may be forfeited by the banks if the borrower fails to make the necessary payments. This means in case of default of the borrower, the bank can forfeit that security. Next one is whatever may be the type of security, the ownership of the security will never passes to the bank. So the bank may have the physical possession of the security. In certain cases, the possession of the security remains with the borrower, and the bank has only the specific interest in the security. Hence, the security is simply a guarantee from the borrower that the loan will be repaid. So, the securities are regarded as a safeguard against the unforeseen happenings. Security may be of many types. That may be land, building, goods, machinery attached to earth, vehicles, gold, ornaments. Whatever may be the nature of the security, while taking the security, banks should ensure that the value of the security should not be of fluctuating nature. Next one is the securities are free from any prior charge. Next one is the securities should be easily storable and saleable in case of default by the borrower. Next one is the security should not be of perishable nature, so it should be durable. And the next is the value of the security should be ascertainable. That can be certain. Securities are transferable without complying with the legal procedure. So these are certain points that must be taken into consideration while taking the securities by the banks. And the next one is various modes of securing the loans by banks. If we talk about the modes of securing the loans by banks, first mode is by pledge. As we know, Section 172 of the Indian Contract Act defines the term pledge. As per Section 172, pledge is a bailment of the goods to secure the payment of debt. In pledge, there is actual delivery of the goods by the pledger to the pledgee for securing a debt. Indian Contract Act gives pledgee a right to sell the goods if the borrower fails to make the payment. On the other hand, pledgee has also right to return the goods to the pledger once the debt is repaid, and the pledger has duty to take the reasonable care of the goods as a man of ordinary prudence would take care of his own good in the similar circumstances. That was the first mode of securing the loan. Second mode of securing the loan, that is by mortgage. As per Section 58 of the Transfer of Property Act, it defines the term mortgage. As per Section 58, mortgage is the transfer of interest in the specific immovable property for the purpose of securing the payment of money, advances, or to be advanced by way of loan, the existing debt or the future debt, or the performance of an engagement which may give rise to the pecuniary liability. This is the definition of mortgage, which is described under Section 58 of the Transfer of Property Act. So, if we talk about the features of the mortgage that can be discussed, the first feature of the mortgage, that is the mortgage is done on the land, building, plant, machinery that is permanently fastened to the earth, that must be immovable. This means mortgage can be made only of immovable property. Second is, in it, ownership and possession remains with the borrower, but the specific interest is transferred. If we talk about the types of mortgage, that can be of 5 types. First type of mortgage, that may be a simple mortgage, where the mortgager binds himself personally to pay the mortgage money and expressly and impliedly say that in case of his failure to repay the loan, mortgagee has right to sell the mortgage property. Such mortgage is known as the simple mortgage. Second one is mortgage by conditional sale. In case of mortgager ostensibly sells the mortgage property on the condition that in case of default of payment by the of the mortgage money on certain date, the sale shall become the absolute, and on condition that on each payment being made, the sale shall become void. On such condition that on such payment being made, the buyer shall transfer the property to the seller, and such transaction is called as a mortgage by conditional sale. Third type of mortgage, that is usufructive mortgage, where the mortgager agrees to deliver or actually delivers the possession of the mortgage property with the right to retain the same until the debt is repaid. Such mortgage is known as usufructive mortgage. And the next type of mortgage, that is the English mortgage or the legal mortgage, where the mortgager binds himself personally to repay the mortgage money, executes a mortgage deed, transferring the mortgage property in the name of mortgagee on the condition that the property will be transferred back on the payment of the debt. Such mortgage is generally known as English mortgage or the legal mortgage. And next type of mortgage, that is the equitable mortgage, wherein the person delivers to the creditor or his agent document of the title of the mortgage property with the intention to create the security thereon. Such mortgage is called as mortgage of deposit or title deeds. And such type of mortgage is generally preferred in India by the bankers. It is easy and simple. It is easy and simple to create and does not require any registration except for limited company. In case of default of payment of the loan, the sale of mortgage property is possible only through the intervention of the court only. And this was all about the mortgage. Now come to the third type of mode of securing the loan, that is by hypothecation. It applies to the movable property, movable machinery, book debts, etc. In it, possession as well as ownership of the security remains with the borrower, and charge is created by deeds of the hypothecation, and the borrower undertakes to give the right to possession to the bank when required. The borrower only submit, that is the stock statement, and the banker has right to inspect the security at any time. This was all about the hypothecation. Next one is by assignment. Assignment is a transfer of an existing or future right on a debt by one person to another, and every assignment is in written form and noted with the debtor who confirms the same. And once assignment is created and registered with the debtor, the assignee gets absolute control over the security, and no other creditor gets the priority over the claim. And the next mode of securing the loan, that is by set off. The right of the bank to combine two or more accounts of the same customer and to transfer the assets and liability from one account to the another account without prior consent of the customer, that is called set off. It is available in certain cases. That is, all the debts should be due and not contingent or the future debt. And the future debt becomes immediately due in respect of the debt or insolvency of the customer. And all the debts should be for certain amount. And the account of the customer must be in the same name and same right. These are certain essentials where the set off can be made by the bank. And the next mode of securing the loan, that is by lien. Lien is a right of the creditor to retain the goods or securities owned by the debtor until all the debts are discharged, but not right to sell. So a general lien gives the right to retain the possession of all the goods and securities in the creditor's possession till all the debts are paid off. A banker's lien is a general lien. And lien debt gives right to sale in case of default of the payment. However, the security should come into the banker's hand in the ordinary course of the business, and there should be no condition inconsistent with the banker's right to lien. This was all about the lending by banks and general principles of lending. That is one of the most important questions for the examination point of view. And if you have any doubt, then you must put down in the comment section. And don't forget to like, share and subscribe this channel for the further update. Thank you.